Rajiv Batra is now joining us. He's head of India, ASEAN, APAC, ex Japan, China equity strategy at JPMorgan. Rajiv, great to have you with us here. And Rajiv, of course, joins us from the sidelines of the JPMorgan India Investor Summit. So it's going to be action-packed next 2 days as I think a lot of investors, a lot of corporates will brainstorm and exchange ideas. And we'll, of course, we are partners. We'll get you lots of conversations from there. Kicking off, of course, with this one. Rajiv, great to have you with us here. Prashant this side, and good to see you. Now, I want to start with, Rajiv, what you put out in a note recently, where you are advising caution as far as mid-caps or small caps are concerned. I think you used the example of what's happened with the SME space, where from the recent highs, the SME index is down about 12% or so. And you're saying that for mid and small caps as well, one needs to exercise some caution here. Could you explain to kick this off, Rajiv?
Thanks, Prashant, and thanks for having me back. So if we look right now, why market is rallying so much? It is rallying because of sentiment, that is liquidity. So we need to track where this retail or this liquidity is primarily sitting in right now, and that is largely in also in SME side. So that's where some of the hit has started coming through, and we have seen close to 14 to 15% kind of a decline since end August onwards. So now if there is a loss of liquidity or a capital in this scheme of thing at the same point of time when you are seeing more issuances in IPO and additional side coming up, that's where the money which was chasing your small and mid cap or even the broader market will start going into a bit on the sideline or bit start getting fearsome. We are not that situation yet over here, but looking at the pipeline which is building up both on IPOs as well as additional issuances side, saying a lot of liquidity will sucked out, and if liquidity has to come out, then most expensive spaces, small and mid cap, and that can go in a correction kind of a mode.
Rajiv, hi, good morning. Just to take that point forward, I believe in that note you are calling for about an 8 to 10% sort of a downside on the small and mid cap space. I mean, some would argue that maybe that's not too bad. That's the kind of cool off that the space needs. What would you advise? I mean, is the general sense that this is a time to stay away, or should you go back in when this dip happens?
So post-COVID, we have seen that the correction duration as well as correction size is reducing, and 8 to 10% is a legible way we can look forward for. Now, in a market where my domestic investors or retail are having a huge position in the small and mid-cap space, the better idea for them would be not to chase the rally, to buy the dip, or to start looking at a weaker time moment which will come. But this will be an opportune time for the first-time investors or even the foreign investor who missed the entire rally in India for the last couple of years. So when they are seeing any quality names are seeing a sizable kind of a correction, which we have witnessed last week during couple of days, that's where they can deploy the money and start making investment into the Indian equities.
Hi Rajiv, good morning. Nigel on this side, wishing you and your team a very, very good conference in the next couple of days or so. Rajiv, but every time someone says turn a little bit cautious on India, we thump the table and say that earnings are in our support and we're going to outgrow the rest of the world in terms of earnings. But we've gone past the first quarter, and looking at your note, there were some downgrades as well from the broader markets. What kind of earnings are you all factoring in, first on the Nifty in this year? And also, do you think that there are far more misses than hits from the broader markets as well?
So thanks, Nigel, and rightly you pointed out, earnings have been the key, and that is the reason why India has rallied 660% over the last 2 decades and outperformed US, which has only rallied only 440%. And that's largely because of an earning. But FY25 have not started on a great note. First quarter earnings was lackluster, and we anticipate even second quarter earnings are going to be subdued enough. Definitely there will be a lot of push and pull. Here the extreme heat waves as a which has hit demand will be replaced by your torrential rainfall, which will also impact the demand. But there will be some support coming from government spending rising post-election, And top of it, rural economy is showing signs of coming back over there. But the problem which is also coming is from urban spending side, where we are seeing four-wheeler demand taking a hit, hotel occupancy rates which are down, white-collar employment is taking a hit. So we are in a kind of a late cycle based on our QMI indicator, and this usually occurs once in a 2 to 3 years. So we anticipate this phase could last for earnings for the next 3 months. Talking about the growth for FY25, we are in the range of 12 to 15%, and we do anticipate the comeback of earnings will happen from third quarter onward, but the right way, when the second quarter approach from October 11, where people need to watch earnings, you should not watch on YOY basis, because that's where, because of base effect, and as I told about some idiosyncratic factor, will lead some disappointment. So the better way to watch will be on the ask rate. With the pending 3 quarters left, and you have a certain expectation for FY25, see how the run rate is carrying on. If run rate meets, then a sector or a stock should benefit. Then largely on the small and the mid-cap side, we have seen close to 52 stocks out of 89, whereas consensus estimates are available. We have seen earnings downgrade happen post result season. Similarly, on the small cap side, close to 40 odd name out of 79 name have seen earnings downgrade. So that's where some comfort is going away, and hence we are broadly cautiously optimistic on markets near-term basis.
All right, Rajiv, we'll leave it there. Great conversation. Appreciate you joining us this morning here, and we will touch base, through the course of the day with your team members, and of course hope to have you back at the end of the conference to give us a sense of the learnings from the conference and what you heard. Thank you very much for being with us here on CNBC TV18.